Property lenders are lining up to provide capital on new projects as the industry suddenly gains momentum, a stark contrast to the situation 6 months ago. Both bank and non-bank lenders are taking advantage of this renewed confidence, according to a survey conducted by Stanford Capital Australia. Joining us today to explain the findings of the survey is Michael Hines, Joint Managing Director at Stanford Capital. Thanks for joining us on The Urban Developer, Michael.
Hey, thanks for having me.
Now, let's just start with the survey itself. Who did you survey and what were the key findings?
So the survey itself, it's a survey we've run now for 4 years. And we cover our whole database of, capital providers. So it covers big four banks, obviously, it covers the second tier banks. It covers, various non-bank financial institutions that are participating in the local market. We cover foreign banks that cover Australia, foreign financial institutions, as well as, the local sort of private capital market. So we were literally ready to press the launch button on the 2020 survey as this COVID thing came along. So we benched it fairly quickly. We did rerun the survey towards the back end of 2020, and we've run the survey, back on its traditional timeline now, sort of February, March. So it's an interesting one this year, given we've got three fairly distinct data sets as we've sort of seen this market evolve through a pandemic.
And so, Michael, what's it telling you about the sentiment and the appetite to lend money here in Australia?
It's interesting. It confirms what we see daily and feel through our business. I mean, what it's told us, as I say, when we're able to look at those three sort of data sets, is compared to certainly 6 months ago, and even compared to 12 months ago, there's more capital in market. It's more aggressive and it's cheaper. It's punching, on the three key fronts.
Yeah, okay. So how does the appetite of the major banks compare to private or non-bank lenders? And I guess where does that appetite sort of transfer?
I think there's often a misconception that the banks sort of, stopped lending. I think banks were actually good supporters of the economy and the property market more generally through COVID. The one thing that has happened is, the banks were belted through the financial crisis. They recalibrated post-financial crisis and materially tightened their credit conditions, both for construction development lending and as well as sort of investment asset lending. The bias has been only further tightening of that credit quality. They've had a regulator who's become a lot more actively involved in their affairs as they've gone through a Royal Commission. So the banks, have set credit standards, which, if you can satisfy, the banks are still long money. They hold, significant deposit bases, so they're keen to lend, but you must satisfy their conditions. And where we saw the non-bank market grow, and this is entirely separate from COVID, was when the pre-sale market in large-scale apartment development pulled back, sort of 3 to 4 years ago. Developers couldn't get pre-sales. If you couldn't get pre-sales, you couldn't get bank finance. It's pretty binary. It wasn't like you got 60% pre-sales, the bank would sort of charge more or lend less. That credit standard sort of was held firm, and then we saw, a number of non-bank entrants come into the construction space. COVID has only accelerated it. In the investment space, is the one thing that the banks, both in the commercial and in the residential sectors, became entirely conscious of was interest cover and borrowers' capacity to service debt. So, winding back sort of 24 months, it was all interest cover. And I think we put out a piece at the time to say ICR is a new LVR because of the pandemic. The Fed, or the Reserve Bank, I should say, in this country has cut the cash rate to essentially zero. Borrowing costs are so low, interest cover isn't the handbrake that it was. The banks haven't stopped lending; they are lending. I guess the non-banks, to get back to your question, they play where the banks don't play, and they do that because nobody's got lower costs of capital than the banks, so nobody's more price competitive than them.
Yeah. Okay. So what does this all mean for developers looking to borrow construction funding and investors looking to purchase assets? What's the wash up of it all?
So in the development space, it means developers have a lot more choice in terms of where they can procure their debt capital from. The non-bank offer to that market, it sort of started to emerged sort of 3 to 4 years ago, was on a steady sort of growth trajectory. COVID was an absolute steroid shot in the arm of that sector. Again, I guess it looks an attractive asset class from the outside. The high level sort of, I guess, view is the banks have pulled back. We can be investing in mortgage secured, investment pieces that are generating fixed rates of return. That's an asset class that's looking pretty attractive when the equities market is so skittish, although it's obviously had a fairly good run. But when there is uncertainty around, and also when people are essentially earning nothing in cash, that sort of fixed income type return has looked attractive, and it's allowed managers to procure huge pools of private capital. In the construction space, developers have a lot more choice, and what we've seen is money is cheaper by a bit. I don't think it's materially cheaper, but I guess leverage that's available is materially greater than it was 12 months ago, most certainly. And the irony is, now that we're in a fairly red hot resi market, getting sort of no pre-sale construction finance a year ago was seen as a bit of a special thing. We just grabbed that off the shelf now. What I think is potentially interesting for developers to stay in that space is I actually think, and we're already seeing, that better developers with better projects are heading back to the banks because they have the pre-sales, can unlock the money, and again, it's materially, it's materially the cheapest capital in market.
So what sectors and types of projects are lenders still quite cautious about?
Specialised asset class financing is always a bit tricky, where you've got underlying, operating businesses attached to assets, but I guess it's a relatively small part of the market. I mean, the bulk of the market is in, resi, office, industrial, retail. Like large scale apartment development, I think people are wary of. That's it. I don't think there's a lot of that getting around market. Again, the pre-sale piece is difficult, and certainly in a New South Wales context, there's been some issues and developments that have scarred that market, and I guess buyers, investors are nervous. So most sectors that I've sort of touched on are performing well. Retail is probably the one asset class that is, and obviously there's retail within retail, I guess. So it would depend, I guess retail centres that have a high proportion of income from discretionary type spend, there'd be a question mark there around, again, the income stream. Lenders are super conscious around.
How do you think the lending environment will transpire in the face of growing inflation concerns, and what does that mean for borrowing? Do you have a feel for that?
Yeah, it's hard to say. I mean, you would think if we see real inflation here, it's going to force rates up. That then potentially becomes an issue for investors or owners of investment assets, because the ICR handbrake, which I touched on before, comes back into play with higher cost of debt capital. So that's probably where the issue is. I mean, real estate's a defense asset in an inflationary environment, so it's probably not so concerning around ratios. The concern might be, increase in interest cost and that relative to income on the asset, particularly where we're seeing, asset classes that investors are favouring. We've probably seen yields tighten over the last 6 months. We're regularly seeing, I guess, primer assets trade with a 4 handle now. And as I say, if borrowing cost comes up from underneath, there could be pressure on interest cover.
And then just generally speaking, over the next couple of years, what's the Stanford sort of house view for the economy and also the various sectors you operate in?
Jesus, it was a hard question to answer 12 months ago. And I'm sure if I did answer it then, I would have been entirely wrong. As I said, wind back to April of 2020, I thought, my God, we're heading for, GFC Mark II, and we haven't ended up there. I don't know. Honestly, I just think there are so many factors at play, health, geopolitical, inflation, which you've touched on. It's a hard one. But again, I guess to stand back and look at Australia, it's a pretty special place. We've been largely unaffected through COVID so far, touch wood. We're a relatively small economy, and being attractive, all we're going to see is further capital flow in here, and I guess you would think if the government opens the borders, the immigration tap could be turned on like instantly. I do think, there's perspective for the bumps along the road, but the long-term prognosis for this country and this economy are quite strong.
Well, thank you for joining us, Michael.
Pleasure. Thanks, Adam.